And that is our cue to get it started. Welcome, everybody, to the advisory angle with the Stratmon Group, powered, as always, by the Chrisman Commentary. And we are very excited to be back here again with you. This is our second week of hopefully many to come. And I am joined again by Garth Graham, the one and only, who needs little introduction. But Garth, hello.
How are you? I was like the way you introduced me, great. So why don't you do it again in case anybody showed up late and
Okay,
missed
just
it?
in
No, I'm
case.
just
Okay,
kidding.
the
All right,
one,
just
the
kidding.
only, the great and powerful Garth Graham. Woo!
All right, thanks.
All
All
right,
right.
all right, all
Well,
right, all right.
that one was even better. Thank
All
you.
right. So I also want to welcome our fellow Stratmorian, Brett McCracken. How are you doing, Brett?
Who needs an introduction? I'm like Garth. You're like, who?
That's right.
I'm a
Bretticus, as we
ghost.
like to call you.
I'm
So,
a ghost.
you know what? No, you are actually the most well-traveled Stratmorian that we probably have, and Garth is right up there with you. But Brett, where are the places that you've traversed just in the past couple of years?
Oh, geez. Bogota a couple weeks ago, Mexico City, Costa Rica. Was in London for a little bit. Gosh, where else? It's
See,
been
until you
a
said
few
London,
spots.
I was going to say muy bien.
Yeah, it's usually the Latin countries, but
I noticed the pattern there.
Yeah, you know what? You've got a good, and what's coming up next? I guess I'll ask you that. I mean, besides, of course, the Mortgage Bankers Association.
Yeah, I think from all those to New Orleans. So I think that'll be next week.
All right, very good. And Garth, and actually, Brett, where are you today? What city are you in?
Home. I'm in I'm in the Show Me State.
All right, there you go, Kansas City. And Garth, it's always fascinating to hear where you are calling in from, and it's a different looking background than I've seen before. So where are we at today?
I'm in Ann Arbor, Michigan, because that's where I am for football season. So no, I think it was the same when we did the refi one. I have no idea. No, I was in Washington, D.C. during the last one of these last month.
Right.
So now I'm in Ann Arbor, Michigan, and next month I'll be in Ann Arbor, Michigan too. So how about that? So
okay,
good to be with you.
Go blue, go blue. And last time we were together, I was on my way coming home from Sturgis. And, from one end of the extreme to the other today, I am in my mom's assisted living apartment. And so here I am right here in the great state of Minnesota and gonna head down for I don't know, some oatmeal or a cheese sandwich in a little bit. So it's exciting stuff here. So, but speaking of exciting, boy, things are getting interesting out there in the market, and the topics that we're going to be talking about today in the next 25 minutes or so that we're together are some very exciting things that are kind of going on in the market right now. We're seeing a little light at the end of the tunnel. We're going to go deep on the purchase market and talk also a little bit about the NAR settlement and the confusion that has seemed to continue to abound following that settlement. We also want to encourage everybody that's listening live here with us, use the chat. Go ahead and use the chat liberally. I'm going to be watching that as we go throughout. If you've got a question, anything to call out, we really would encourage you to go ahead and, as I said, use it liberally as we're chatting. And Garth, I'm probably going to turn to you first as my computer's trying to reboot, which is always awesome. I'm going to turn to you first and really talk about, kind of what we wanted to chat about was really kind of digging into you had an article that was published very recently called How to Win the Coming Battle for the Purchase Money Market. And that's really what is the topic in a lot of people's minds right now. So I'm going to turn it over to you first and take it away.
Yeah, I appreciate that. So yes, just this last month when we talked about it, we did a very similar article. So it was kind of a two-part. And in the first one, we were sort of saying the decrease in interest rates, which is imminent, we just don't know when, or it's likely, but we're not sure exactly when. We're not sure how much. We're not sure for how long. And I'm not here to be the economist to predict any of those. I'm simply saying for the refinance, I said, the refinance increase, which is likely to occur, will not save everybody in the industry that is struggling right now. And the reason I say is it will not save, there were a number of reasons that we called. So if you didn't watch that in the YouTube, go to the YouTube channel and, watch the refi one from a week ago. This is sort of a similar item here. And I do not believe it's going to save everybody equally or improve the performance equally of mortgage companies that focus on purchase. So in other words, if rates drop, will our purchase market improve? And I'd say, yes, it will improve, but I don't believe it'll improve equally unless lenders take advantage of the opportunity. So, the first big warning about that, and then I'll invite you guys to respond, is that if interest rates go down, by definition, it increases affordability. Yay! Unless prices go up. So the problem there is going to be in certain markets where it may create a significant pent-up demand, people on the sideline and not enough inventory. We may see an increase in sales price that offsets the decrease in rates. And I'm sorry to bum you out. It really depends. And it will take a big drop in rate in some of those markets. So whatever you are, if you're a loan officer or a company that manages loan officers, you've still got to keep all of your sales skills sharp, your product skills sharp. Your people are still going to want the 2-1 buy downs. They're going to want to look at DPAs. They're going to want to look at all those things that help in affordability, even though interest rates, we may be in a 5% market instead of a 6% market. So that would be my first warning. It will not bail us out from some of the affordability challenges that the market is facing.
So one thing I'll jump in with on that and invite Brett to do the same is that, it's interesting because they've been talking quite a bit about, in fact, we just had in July, the 7th straight month of slowing home price growth. Not the same thing as depreciation, right? Except for in,
Correct.
Limited markets, sometimes people hear a deceleration as the same thing as depreciation, which it's not, but it's still going up, but just not quite as quickly.
Yep.
They're now, however, house prices nationally are now 55% higher than pre-pandemic. Going back to February 2020, home prices now are 55% higher. So, however, and again, this is from First American's July National Housing Price Index, saying that we are continuing for the last 7 months straight to see at least a continued slowing home price growth, which hopefully would help to offset some of what you're talking about, Garth.
100%. And by the way, the other piece of advice I gave is, we're talking macro trends. We're talking big picture. And I already said, hey, it depends on your market. Well, you need to know your market cold. So that's a great reason to have discussions with realtors. You bring the mortgage related advice to the table. They bring the real estate local market color. Now you two are collaborating on what messaging you can give for homeowners that may make them more comfortable about what the options are. I mean, you need to know what's happening in your local market. Less important, what we're saying from a macro perspective.
Well, but you do bring up, I think, an interesting point, though, as there's going to be, as people do start to come back in the market, as interest rates go down, there's going to be more competition, which tends to have the opposite impact in terms of prices. Exactly. That could head them right, back up higher.
Back
again.
up.
So,
well, and that was, by the way, I don't know if you guys see, and she pops up on my feed because I probably watched Shark Tank way too much, but Barbara Corcoran. It literally every time I see her on Instagram, that's what she keeps saying, and she's been on CNBC, is that when the interest rates drop, the prices are going to go up. Now, Barbara Corcoran makes money at being in the real estate market, so it's but I think she truly believes that Corcoran Group is that the real estate prices are likely to go up, not down. So hence the affordability issue.
It continues to be crazy. So Brett.
Yeah.
I think there's just so much complexity here. It's not just from the banking side, it's not just from the real estate side, but I talked to somebody the other day who I think is the perfect example. They would think about moving, but as behavioral economists would say, they've been price anchored, right? They're sitting on a 2.5% interest rate. And the wife said, okay, let's say we do sell our house. We'll get a great price for it. But then when are we going to move to? They can't find a house that they want to move to in the school district where they want for their kids. And then they're also going to see a rate, probably in the 6s. Depending on the day and when they move. And so the phrase that she said is, I just feel like we're a household hostage. This rate is holding us here and we don't necessarily want to move. I've heard other people say, well, gosh, what if we keep the house and keep our low rate, but now we become renters? Do we really want to become renters with our busy lives where say if they're parents or they're just busy working adults? Do you want to be taking that 2 o'clock call in the morning that a pipe burst or something needs to be fixed? So it's just the complexity, not only what's going to happen with rates, but as Garth said, everything's local. And rate, you can sell for a high price, but then where are you going to go after that?
Yep.
The other, another thing I will tell you that I got myself skewered when I made the comment once to someone about, it's like, rates 6-7%, big deal. Back in my day, rates were, da 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 da. And that person said, yeah, what was the average price of a house back in your day? And I was like, oh, cringe. Yeah, because it was, you're buying houses for 90 grand, back then and less. And so it is, it's kind of this double whammy of, to your very good point, you've got these high interest rates, but just the average, what is the average home price right now? Something like 455,000 thereabouts,
Mhm.
pretty,
So,
pretty steep.
yeah, so I've been in the business long enough and that I remember that I got in the mortgage business because we were in the middle of a mini boom because rates fell to 11.5%. And the average conforming loan limit was 103, $450. Now, the fact I remember that is bad enough. But the point is, yeah, that's a great point in that, back in the day example needs to be put in context.
Right on. But, you mentioned Garth and you talk in your article, which we'll post a link, by the way, to that article here in the chat. And if you're watching the replay on YouTube, we'll make a comment that's got a link to the article. It's a very, very well written article, as we always try to do at Stratmor, of course. You can see the archive of articles as well. But you do talk about, there's multiple factors going on here, Garth. So talk a little more about, what else could happen here.
Yeah, I think so. Here's the big one that I got, and this sort of introduces the concept of the what the NAR settlement may do. So full disclosure, one, we just gave, we're not economists and gave some speculation about the economic impact. And number two, we're not lawyers, and now I'm going to make some comments on what the business implication is of a legal settlement. So I'm just, that's the world of consultants. So here's the piece in the numbers. In our industry, macro, we have roughly 3 million purchase loans a year. We have roughly 1 million realtors who are active in our business. The NAR has more members than that, but there's about 1 million active realtors. I'm sort of rounding the numbers here a little bit. There's roughly 100,000 active loan officers. The number most recently, by the way, was about 80-some thousand. But let's just say market improves a little bit. So keep the numbers easy. 3 million for 1 million realtors, that's 3 a year. There's 100,000 loan officers for the 3 million deals, that's 30 a year. That is almost exactly what the average numbers are if you talk to the NAR, if you look at our peer group data. The average loan officer does about 30 purchases a year. They have a good year when they can also add 30 refis a year. And as my last article said, I don't think we're going to hit a 50-50 refi purchase split. So we're still having to fight over the purchase loans. So the loan officers at 30 retail deals a year are chasing 1 million realtors that average about 3 each. But at the real estate side, like the mortgage side, is about 80% of the business is done about between 25 and 35% of the people. So the average is about 30% of the realtors that do about 80% of the business. So a lot of loan officers are still being propped up by the very few deals done by the part-time realtors, the realtors that don't do enough business. So the realtors are being propped up by that, and so too are the loan officers. So what does this have to do with the NAR settlement? The part-time realtor, I believe, hypothesis is being propped up by the fact that the typical seller-buyer split has always been this established thing. So the listing agent gets the listing and says, hey, you can work part-time realtor with all these buyers, knock yourself out, and I'll give you half the commission. Well, suddenly, if that's all negotiated, and suddenly, if it may make more sense that the big producers try to produce more from these buyers, or the listing agents start trying to take control or do more on the buy side, you may see a dramatic reduction in the number of part-time realtors who can survive. And what that means is that I believe could drive a dramatic reduction in the number of part-time loan officers that can survive. And maybe they're not part-time, they're full-time. But the point is, if we're 3 million purchases and 1 million realtors, what happens if the 1 million realtors becomes 500,000? It's going to create even more consolidation in the mortgage business. even though the market may be getting better. So it is, to me, it is the cautionary element in the industry that may make the numbers perform differently this time.
So is the word of advice there, Garth, about relationships, about really watching where your realtor partnerships are, your realtor relationships? You know, I certainly know people who, you know, kind of work with a wide variety of different types of agents, including a lot of those part-time agents that you're talking about. And it's competitive out there in terms of getting in front of those people and helping them out. But you're also hitting on specifically on the buy side, which we're gonna, you know, shift and talk a little bit about NAR settlement, buyer's fees, and so forth. But you know, that's a realistic issue. What would you say is your headline piece of advice?
Yeah,
on
my
that?
headline piece of advice is you need to be able to have meaningful relationships with the most successful people to protect your business. You can't rely solely on having a number of part-timers, because if they begin to go away due to consolidation, or because of their ability perhaps to not be able to negotiate their fees as effectively, whatever it might be, you're at risk because you don't have the relationships with the right people. So have relationships with the high producers to the extent possible.
There's
Yeah,
go ahead.
and the other is, I think there's a possibility already the vast majority of home search starts online. You then go offline with a buy-side agent in order to get into the house, which is established through the 3%. But what if you could go very quickly from looking online to click a button and get access to the property, which is probably at the realtor level or at somebody or something that has built a relationship online with a consumer. At that point, you better also have very solid tools that enable the consumer to interact with you on finance. What's my monthly payment? How much can I afford? Can I easily apply online? And we've relied too much on, in the past, the buyer agent can deal with the customer and then hand it back to us, and then we'll take over. But if it really gets seamlessly connected to that online shopping experience, you better have a really good way to connect with it from a company perspective. So that would be work with the right people and have a really efficient way to work with them.
It's also a place that, you know, when I go back, you know, back in the day, when I think about that's when this, you know, 7% real estate commissions and how much goes to buyer's agent, how much goes to listing agent was kind of determined. Again, the other side of that coin is, you know, you were looking through books. You were not, people were not looking around online. You literally were, and Brett, no comment, please, from your generational demographic at the moment, but you know, they were looking through books and houses were about $100,000, you know, as you said. And so they were earning those commissions in a little different way. But Mr. McCracken, I'm sure you've got a comment about that.
Well, I think what's been interesting too about the NAR settlement is, you know, the standard commission of about 6% being split between the real estate agents. I think for a long time, people just kind of accepted it, right? It was just very cultural here in the US, but it made people go back and think, how did this all get started? And I think it was back in like 1913. I think was the first time that it was at 2.5%, as I recall, was the commission, and that climbed in the 1940s to about 5%. But if you look at how we buy real estate here in the U.S. and you look at other countries around the world, sometimes we're 2 to 4 times higher, right? And so as technology has come out, you've seen other countries go down in the cost. And I think in the UK they went from like 3% to 1.5%. In the U.S. we typically stay over between 5 and 6%. And so the kind of core issue there is that the same thing we see when lenders go from a refinance environment to a purchase environment. Executives say, wait a minute, we're paying out more in commissions than we've ever paid out. Why is that? Because the loan amounts are higher, right? Well, now we have an environment where the home price purchase is higher. And when you're at that 5 to 6% level and you're selling, you know, 2 million homes, I think there's 200 different cities in the US where the average home price is like above $1 million. And that's a lot, obviously, in California. Right. But you say, well, gosh, if I sell $1 million house, you know, 50, 60 grand's going out the door to some real estate agents. And I always kind of chuckle when I see that a house was listed and it said sold fast. You know, we listed it Monday at 9 a.m. and somebody made an offer that we accepted by 5 p.m. Okay, well, that's $1 million house. Yes, there's of course work that leads up to that. It's not just magic that it gets on there. But if a house moves in a day, $50,000-$60,000 of commission on that, that's a lot of money going out the door for sellers. So people start to
Right.
really kind of think about and question.
By the way, here's the other piece I would say too, just to be an equal opportunity offender here. So as mortgage professionals, I think we also have to look at our own compensation piece too. It's very easy to say, hey, that realtor's at 6%, boy, that seems high. Our 1% kind of seems high too. And I started as a loan officer, by the way. So before everyone says, oh my God, the consultant's telling me I made too much money. I was a loan officer. I managed loan officers, had a mortgage company that had loan officers, et cetera. So I get that there is a high degree of compensation for this self-source relationship model in a very complex industry. I completely get it. The issue is that affordability number keeps going up. Like Brett says, our number keeps going up in base dollars. The threat is if the real estate size, as their commissions start to collapse, if they also begin to consider the dual licensing option, meaning they can be the originator for the mortgage and the real estate. And by the way, all realtors already know everything about our business. They'll tell us that in every interaction. So there you go. I'm covering all of that bases.
Everybody's a fan. So
there you go. So we'll cover title next. So the point is they may become, hey, I'll do for like be a broker for a half a point. So what is that going to do to our 100 basis point commission model? So in addition to saying we got to be working with the right people who are really doing business, we got to have a really streamlined process that kind of aligns with the future, more at least being sourced online, searched online, engaged with online, even if it becomes an offline conversation. I think we really got to take a hard look at whether our compensation model supports that future as well. And you could pay differently for a purchase and refi. You could pay differently for certain loan quality attributes. You could pay per dollars per loan instead of basis points. I've written a previous article about all those compensation pieces, but I challenge lenders to think about this. If some of these things happen, what are things you can do to maybe turn the economics around a little bit?
Before we shift gears, and I know we want to go a little bit deeper on the NAR settlement and talk a little bit about kind of what's happening in the market, based on that. There's some really good questions and commentary coming into the chat here that I'm going to pull out. Of course, our good friend Scott Payne is asking, what does AI say that the market is going to do? So I'm going to encourage you, Scott. Why don't you go chat GPT it, and you can pop that into, and we'll all group judge the result of what AI says the market is going to do. Hope had a really good question here talking about new construction. So she said, what are the stats and opportunities for new construction as an option to address the limited inventory? And Garth, I do know that, the builder sentiment has been pretty poor over the past year. And so talk a little bit about that.
Well, they have their own sort of existential issue on how the heck they're going to be able to build enough homes in the current, whether it's the regulatory climate or the affordability climate. That's sort of its own macroeconomic piece. Right now, though, the percent of new home purchases as a percent of total purchases is substantially higher. Historically, it's been 10%. So we'd all say, the builder and the builder mortgage companies, that's like 10% of the market. I mean, depending on geography, during some of the most recent periods, it's like 30%. So it is like a real compelling piece. If you have the ability to develop relationships with local builders or local construction companies that are in the remodeling space, because a lot of people are doing the remodeling versus the new construction, and that's a meaningful opportunity for you strategically. It's a different skill set, but it certainly is an opportunity. And as a percent, it does appear to be going up. Having said that, they got their own macroeconomic problems on just, acquiring the land, getting the approvals, lumber costs, et cetera.
Regulation. Yeah, exactly. All right. Bunch more questions and comments stacking up here that I'm going to weigh in with. And Brett, I'll pitch this one to you. Nancy's saying, but if there is more inventory, it could create a more competitive market, maybe more choices for buyers, possibly moving more to a buyer's market. What do you think? Brett?
Yeah, look, good question. I mean, Garth brought up the point about just kind of going back to more construction. So there's more inventory. You have to have rates low enough where people feel comfortable to leave that 2.5-3% rate, and they have to feel comfortable they're going to find a house, like we talked about before. There was a really good piece though on kind of fixing the housing shortage. Actually, in your backyard, Sue. It was a Planet Money episode recently about
Yes, I listened
Minneapolis.
to it. I listened to it.
Really well done. You guys had a very
Yeah.
ambitious housing plan for how to add more units, and everyone signed off and agreed to it. And the neighbors, it's the typical not in my backyard, right? And so people don't want their area to change; they want some other area to change. If you want to add more housing.
Yeah.
So this kind of goes back to the complexity of the entire matter, right? It's not just people that are feeling comfortable to move, but where can you build? How can you get through the regulations and all of the factors that go into kind of adding the 4 to 5 million more units we apparently need in this country. Now, I'm kind of curious about, as every time I travel, Garth, around the road seeing a client, I always see construction going up somewhere for new housing, but a lot of massive apartment buildings too.
Rentals, yeah.
Massive apartment buildings, rentals as well. So I kind of wonder if we don't get to a point where people are running into the market and they saturate it. And then if we have a little bit of a turn of events, the market starts to soften a little bit, home prices come down, you've got more options for where to live, especially in certain cities. Does the problem start to even out? The challenges start to even out?
Okay. Hey, one question I've got, Sue, by the way, because we're not going to be on here forever. There's a lot of really good questions. So
There's a lot of really good questions.
So
yeah.
can we put those in YouTube when this gets posted? The
We
Crispin
could put them in
commentary
YouTube, but I don't
Yeah,
think our
so-
time's turning off in 3 minutes either. We could just kind
Okay.
of roll a little bit and just.
Okay, well, you keep going then.
I'm gonna keep going,
Okay.
ask just a few of these. I have to launch out, just because, Chris Sorensen's, just such a huge, huge talent, big friend of mine. He made a comment when we were talking about real estate agent commissions, and he said a professional realtor who is an expert in their target market, who understands local nuance, as well as being trained to be an expert negotiator, is worth their weight in gold. If a house moves in a day, one is paying for the work that a realtor did years prior to taking that listing,
Yeah,
not just the listing of that one home. So fair point.
That is now, Brett, you can choose to answer in English or Spanish since you're.
So I give the consumer's perspective. Chris gives the agent's perspective. This is true. I know some people that I learned a new phrase. It's called a pocket deal. I was unfamiliar with this, but somebody said, look, this isn't even going to hit the market, going to go on the MLS, but it's a real estate agent who's well connected in the community. They know about homes that are coming on the market, and they can find buyers before someone has to even go through that process. I had a friend of mine who had that exact same experience, and the gentleman came in, took a look at the house, made a very generous offer, same day. And so you're right. There are some agents. This kind of goes back to Garth's point. If we go from 1 million, 1.5 million real estate agents down to 500,000, the people are going to be left are going to be highly professional, very well connected, and they're going to bring some value to the table. So I don't disagree.
Yeah, no, I think his point's a great one too. And Chris, I invite you to come off, to put in the chat. If you're a really good listing agent and have a really good inventory, would you consider working with more buyers directly? And that's sort of a little bit of the supposition. I think there'll be a dislocation in the market because at some point you're like, well, if the buyers are if I'm having the inventory and I'm super professional and I price the inventory well and the buyers are engaging with my website, why not have an assistant or two that just engages with the consumers directly? And maybe I'll do it for, make a little extra money. So that's sort of an example of the dislocation. I think there's some super competent professional people who deserve the money they're getting and may be willing to do more work to see the entire transaction. And I invite anybody to look in the chat, by the way. Chris's point of, hey, you could use some of the commission to buy down the interest rate. I mean, that's just awesome. Right.
Yep. And also about open houses being more popular than ever due to the fact no contracts are needed to be executed for a buyer to visit that home. Right. Exactly. So there's some really interesting things in here. There was an anonymous attendee who put a question in that said, why don't the realtors use this as an opportunity to evolve and introduce a buy side agreement with a percentage and a min max component similar to many broker and loan officer comp plans in the market?
Well, I think I think there'll be a number of things like that. There'll be, I still think it's still going to create a level of disruption, because that means you have to get a buyer who just clicked around on a website and then maybe called his cousin's friend because he said, I'm ready to look for some homes, and immediately is told, okay, you got to pay me. And they're like, whoa, well, I'm not really sure what I'm trying to do, right? So, it will create some disruption because that conversation is going to have to occur. I think, that's another good example that probably will occur.
I'm going to pitch this to both of you and see. Oh, Brett, go ahead.
I think the broader point here is going to open up. There's going to be several business models that
Yep.
That come out of this. And one of the things that I noticed when some of the people listening also pay attention to Mike Del Prete up there at University of Colorado in Boulder, and he had his hub event a few months ago, and they had people from a guy from Compass, from EXP, and then from local brokerages that just specialized in their area. And what became very clear as each one of them was talking is there are multiple business models that can exist at the same time, right? It's not
That's right.
It's not one business model that's going to play out. And
Right.
I did notice actually while kind of doing some research and preparing for this, one of the named plaintiffs in the NAR lawsuit has already spun up a company, and it's not a brokerage, but it's on his website, and it shows here's a traditional, if you pay 3% commission, $500,000 house, here's the 15 grand you pay out. But theirs is a price per tour, a price per offer. They have an option to pay the at closing, or you can just pay as you go. And so it's just one more model that's going to come out. And I think that you're going to have the traditional model that's not going to go anywhere. And then you're going to have some new models that get introduced into the market. And I just think there's space for all of them, quite frankly, for the consumers to choose what works best for them.
Yeah.
I'm going to shift gears again and go back to, because Terry is asking a great question that I think, Garth, when you wrote that article on compensation, a lot of feedback, from the market, right?
Yeah.
Terry kind of gets at the heart of it and saying,
who's going to be first?
who's first? Yep.
Yeah, who's the first to jump off the cliff and hope everybody else follows? So one thing that I pointed out in that article, and we'll put the link in the YouTube for sure, so I feel like going, click here, okay, is that you don't have to change everybody. You can change some people, and you can bring new people in the business under different models. You can take your high producers and say, hey, no problem, but let's layer in the loan officer assistants and build a different model around them. In some cases, though, if you have a lot of low producers who also have a lot of low producing realtor relationships, you may choose to recover some of the money by not maintaining that staff. So I mean, I hate to say it that way, but to say, do I really want to build my model? I'll build my model around high producers who have a lot of high producer relationships. I'm going to bring new people in, put them on different compensation for the future. I'm going to free up the money by the draws and the expense of the people who are low producers operating the old model, because I'm concerned that that old model is beginning to change. And the other thing that I would say, when you look at LO compensation and cost, and we do some work in this area, and it is remarkable, if you need to get down to profitability per LO, because often a low producer, they may bring you incremental volume in a tough market, and that feels good, but they also might have higher price exceptions, pull too many credit reports, have a lot of underwriting suspenses, too many conditions, price extensions that cost money. I mean, at some point you're like, what am I doing this for? So look at what the profitability is that's being generated by the person, and then really think about how you can adjust the compensation accordingly. But I appreciate the question, Terry.
Brett, anything to add to that?
Garth always just nails it perfectly.
Well, we'll go to closing comments in a moment, but I will say that Scott Payne came through in the chat, which we'll also post over on YouTube in case you're walking well, it sounds a lot like how a politician would answer that question.
Yeah, it was good. But
Right?
basically, AI thinks it's still a seller's market. So, the prices are still going up. That's what the AI punchline was.
No, it's very even-handed though. It's very politically correct. And so good stuff there in the chat. So check that out and we'll be sure to paste that over to YouTube if you're watching the recording here. But gentlemen, I'll ask before we do wrap up here. Garth, you've given some really good, takeaways in terms of pieces of advice for folks that are listening, whether you're lender, leader, loan officer, wherever you are in the mix. You've talked about some of the most important things. Anything that you would add to that as an action point?
Yeah, I think the big one is understanding what the data is telling you about where your business is really coming from and how much money you're really making by loan officer, by branch, et cetera. But then keeping in that you can't just assume, and really the tone of the two articles I was trying to get, and I can be deliberately provocative sometime to make these points, but the tone I'm trying to get is there's things happening in the market that are going to make a rate drop not perform the same this time. I really believe it. And I gave 4 or 5 examples on refi, and I gave 4 or 5 examples on purchase. So that's really don't just assume that, the hit of methadone that we're getting associated with this drop in interest rates is going to make us feel as good as the last hits of methadone. And that was a horrible analogy. Can we rewind and edit that out? Geez,
a little, wait,
I went a little
Breaking Bad.
dark there. All right.
Breaking Bad right at the end, but all good. Brett, what any drug-related analogies by way of piece of advice that you would like to offer?
Yeah, I did not have meth on my bingo card for today, but Garth came through for that one. I'll just leave kind of, I guess, what my chief concern is, and it's a group I hope does not get left behind. That's the first-time home buyer in all this, because loan officers, typically, if you can work refinance transaction, that's a very binary transaction. Are you trying to take cash out? You're trying to consolidate debt. You just want a lower rate. It's a very mathematical equation to do that. If they're working with someone who's purchased home before, they've got some equity, they have down payment, that's an easier transaction. But if someone's a first-time home buyer, sometimes like, okay, this is going to be a lot more work that I need to do. But this is the group I'm most concerned about, is getting people into home ownership. I think as of May of this year, the St. Louis Fed reported about $33 trillion in home equity in the United States, right? And that certainly skews for people who have been able to get in early, held on to that home for a long time. But if you're a first-time home buyer today, you're facing a lot of challenges. First, you already come up with the down payment challenges, and not a lot of banks, credit unions, and IMBs specialize in down payment assistance, right? It's challenging to do it, but I'd like to see more expertise there. You got rising real estate taxes. So as the prices are going up, it's not just the payment, the principal and interest you're paying, it's also what are real estate taxes doing? I've seen people in certain markets that are having to sell their home literally because they can't afford the real estate taxes. Homeowners insurance, Garth has doubled. We talked to a lot of people who said their homeowner insurance is going up. If you got first-time home buyer, you also got to furnish the house, fix the problems of the house, and now you got to figure out a way to pay for that real estate agent if they're not going to be offered, 2-3% that's going to be coming from the seller. And so I'm most deeply concerned about people who are first-time home buyers and how are they going to be able to start generating equity in a home, especially for generational wealth. It starts passing down from family to family for groups, especially that have been marginalized throughout the years of buying homes. So it's kind of my chief concern right now, but I think that's also where the opportunity is. I think there are going to be some companies out there, real estate brokerages as well as lenders. They're getting really, really good at especially helping first-time home buyers. And if you're exceptional at helping them, you're going to do just fine with the cash out refinances and the VA IRRRLs that come your way as well.
Right on. Chris came in hot with another interesting comment. I'll just ask for a 10-second opinion on this before we wrap up. Dual licensure. So he makes the comment, smart agents are considering getting their mortgage license and partnering with the right company and individuals to offer similar. And so speaking as someone who's been dual licensed for decades, I was far better at conversion by demonstrating my ability to communicate at a whole new level. So Garth, 10 seconds. What do you think of dual licensure?
I already commented that mortgage companies, I think, need to get a good hard look at the compensation that they're paying, because an example of that is likely to be at a lower cost. And, you're going to have to justify what you're collecting. And by the way, the dual piece can go the other way too. You can have loan officers or loan professionals who can also begin to participate in real estate. But I think that is an absolute potential morphing of those two experiences.
All right. That was 12 seconds. Brett, what do you got?
Bam.
Hey, interesting point, right? He mentions Homes, Redfin, Zillow. These are companies that came in to disintermediate the incumbents. But if you go back 40 years and look at agent-assisted sales, 1987, 80% of people selling a house used an agent. Between like 2015 and 2023, 89% of people are using an agent. So even as these companies are coming in to disintermediate, there's a lot of folks still relying on the tried and true. I'm going to go with a real estate agent, sell my house. So as tech comes in, it's one more option, but so far it's not completely disrupted.
All right.
Yeah,
Well,
yeah,
gents,
very
I
cool.
think we are at the end of another episode of the advisory angle. So I'd encourage everybody who's listening, whether you're listening live or listening to the replay on YouTube, connect with us on LinkedIn. We're the STRATMOR Group. I'm Sue Woodard, joined today by Garth Graham and Brett McCracken. Love to connect with you on LinkedIn. We have a lot of fun out there. Upcoming conferences, we're going to be at the digital conference coming up next week in San Diego, and we're going to be at the Mortgage Bankers Association annual event as well in Denver. And I think most importantly, join us again for the next episode coming up next month of the Advisor's Angle, powered by the Chrisman Commentary. Thanks everybody for joining, and have a good day.
Awesome.